I'm so excited about this week's Money Mondays. I have a very, very, very special guest, somebody that I respect from Boston. He's out of Boston. He is a incredible guy in the money business, about investments, allocating investments, and he is just, I mean, his background is just absolutely incredible. Vetted, is responsible for really taking care of people's money, and honestly, he deserves to take care of people's money because he is one of the most ethical, responsible, and incredible guys. And I invited him over here. He's not a publicity guy. He never ever talks on the camera. He's very, very private. So I feel very privileged that I can even get the opportunity, and I hope you feel privileged too, that we get a chance to talk to him about money, because it's part of. I learn every time I talk to him. I just hang on every word he says. So to that ado, I would like to introduce my friend G to you. So
Thank you, Andrew. It has been an incredible experience over the past 6 years meeting with you and your wife, lovely Anya. And I learned from you guys incredibly a lot from your experience building up companies and structure deals. I'm very grateful about that. But first of all, a bit about my background. I came here from China a number of years ago, from a moderate family. My parents were teachers, and I really, by coming from that background, I really understood the importance of money, how it can change people's life, right? That's what it motivated me come to this country, America, land of opportunity, to pursue my advanced degrees and pursue a career in finance. That's what motivated me. And today I work for a global financial service firm, managing money for other people, for other institutions. I think that in this business, trust is the most important thing you can have, because it's a people's business, and without trust, nobody will give you money to manage, right? Besides, you can find good investment opportunities, but first and foremost, trust is important. So whenever we make investment decisions, we need to put our client's interest in best interest in front of anything. Your self-interest, even your company's own interest, your client interest is the most important. When we manage money for our clients, I think we treat their money the same as our own money, right? So when you deal with your own money, so you think about risks. If you just think about other people's money, you want to make a fee and a performance, you are inclined to motivated to take more risks to achieve potentially higher returns, to get more economic interest. But when you manage your own money, you need to factor your risks, right? So you don't want to take excessive risk. In this industry, we call it fiduciary, right? Fiduciary meaning you manage other people's money the same as your own money. I think that's the most important element of this industry, the trust, and you always act as a fiduciary. Besides, you need to have the quality of identifying investment opportunities which will achieve high returns at a reasonable risk level.
yeah, it's funny, you'll hear fiduciary and fiduciary, which most people don't realize that when you're a fiduciary, you actually have a responsibility, a legal responsibility that you can be held accountable for. In the state of Nevada, several licenses that I carry, I have a fiduciary duty, not a fiduciary. So
Right.
I am like literally not responsible for the investment of other people. It's different. So literally, when he says he's investing money like it's his own, he's actually accountable as if it's his own.
Right.
So, and I think that's it's an important distinction when you're working with people, that you know the difference between a fiduciary and a fiduciary.
Yes.
right? So it sounds the same, but it's not the same, because literally when he signs with his license and your fund is, I think it's $2.6 trillion.
Our
Two point
firm,
six trillion dollars.
that's our firm managed about $2.8 trillion.
2.8 trillion.
Our
Excuse
team,
me.
of course,
Excuse me.
managed
I'm
small.
sorry. I'm sorry. 2.8 trillion. You know, it's just chump change. You know, it's
Right.
only.
But that's a huge trust other institutions put on you, right? For
Right.
our company, we've been in business for hundreds of years, starting with as a bank to evolve into a multifacets financial services firm. You know, to survive over a few hundred years, it says something that conservatism and put client interest in front of your own interest is critical. Besides, finding opportunities, adding value to, or just returns to your client's portfolio.
Yeah, it's fascinating too. But and then also the pressure to keep your operating costs really low is a definitely other aspect, right?
Yeah, we are a publicly traded company. I'm not going to name the name.
Yeah,
Since
I haven't named it.
Yeah,
either.
as you said, I'm a very private person, and
This is a private, for your eyes only type thing. So this is not in any way representing the company that he's with,
Yeah.
or representing any representations to that company whatsoever. This is a personal friendship only. So
So as a publicly traded company, we what are our stakeholders, right? It's our shareholders. It's first and foremost, it's our clients, then shareholders, employees, right?
Yeah.
And as a shareholders, we need to, because we are subject to the tyranny of capital markets, the volatility of a stock price. They always expect you to grow your bottom line certain percentage, right? To have your stock price appreciate over time. So we are, as a company, we of course always are mindful about controlling cost, how to deliver services, the best value to our clients at a reasonable low cost, right? That's important as a publicly traded company. That's a reality on Wall Street. You have different stakeholders. One of them, very important, is your shareholders, right?
How long have you been doing this?
I've been doing this for over 20 years. I love it. This is like after my graduate school, I did my summer internship, and I got accepted as a full-time employee, and I love it. The thing is, what I really like my job is it challenge myself every day to find, investment opportunities for our clients to help our clients to achieve their long-term financial objective, right? That's critical. That's really rewarding. You feel like very fulfilling. You do your work and find the opportunities, help your clients to achieve their long-term financial well-being.
Yeah, that's amazing.
And along the way, you have fun by meeting with outstanding entrepreneurs like Andrew and portfolio managers from different firms and other interesting people. You learn a lot from other people. This is like a really interesting career.
Yeah, I think when you're vetting a deal, right? I mean, you're really in some ways boots on the ground because you have to understand the numbers.
Yeah.
You have to look back at their balance sheets. You have to look at their income statements. You have to look at their cash flow statements. You have to figure out not only the staying power, but also the management.
Yeah.
Right? Do they have the skills to pull off what they're doing and for what period of time? And then also the revenue model, right?
Yeah.
Like you've got to hit targets,
Yeah.
right?
I think you bring out a really important point. When we look at investment opportunities, investment return is only one thing, because if you look at investment team, what they did in the past, but past performance may not necessarily predict the future performance. What we try to do is identify these investment teams can repeat that past success going forward, right? That's a critical. Now, how we can do it by looking at the team, their pedigree, but first and foremost, where are the inefficiency in the market, right? uh, if there is inefficiency in the market, whether it's equities, credits, or other esoteric segments exist, if the team has the necessary knowledge and the resources to capture that inefficiency, or other people call it alpha opportunities, you can beat the market, beat the benchmark, add value to your client's portfolio. But that's only one element of when you make investment decisions. Because investment return is only one element, you need to have behind that, you need to have a whole slew of resources from operations, compliance, and all other infrastructure to support that investment process, right? So we have a dedicated team looking at the operation side of the firm, looking at that process and the controls to mitigate any errors, mitigate any potential fraud risk. These are all important besides the investment return to our clients. No clients want to be in the headline of any fraud. No clients want to be associated with this kind of headlines, right? That's important for us to do all the due diligence before we make investment decisions to help avoid all these potential problems in the future.
You know what's crazy too? One of the people we've read about just got hit for $340 million. Warren
right?
Buffett, yeah. He invested in a solar company, and the solar company turned out to be, obviously the internal controls right there, and it was able to pull out a lot of money. Part of that, the incredible thing about keeping the brand and the reputation you have is knowing that the internal controls, part of the process of underwriting a deal is understanding that the flow of money, like how money flows through the organization and how it ultimately, with the waterfall effect, how it's going to pay all its expenses and bills, don't leave gaps or holes for parties to be able to take money out of the company. So the internal processes are critical because nobody should ever have to really trust anybody in the business, right? I know that sounds weird, right? You think that business is based on trust, but ultimately it's based on internal controls, policies and procedures, and following, certain accounting principles that, you can sign off on. It's how, and this is what's weird, and I think that the common person doesn't understand. The United States is really built on all of these different structures that help secure our equities markets, right? To know that what the multipliers are, what the PE ratios are, it's like when you look at it, if your internal controls are proper, if you vet all the principles, if you check out all their backgrounds, right? Literally, you're going to reduce, you can't get rid of fraud.
Yeah, you reduce the risk, right? And
Yeah.
as a fiduciary, the due process you carried out, right, will help mitigate not just the risk for your clients, and it mitigate the risk for yourself,
Correct.
right, for your organization. Because as a bigger organization, even smaller organization, you want it to be durable, right? As an investment business, you want to look beyond the generation, not just you. You want to, in the future, next generation can carry on, helping clients achieving their financial objective. That's so critical. You have a vision looking into the future. Now, to achieve that end objectives, you need to, along the way, manage all the risks besides just achieving returns, right? Or what Andrew talked about and I mentioned about on the organization front are really critical. Because it's not just fraud. Even over the past over 20 years, I saw quite a few managers. They are incredibly smart people, right? They can be a good portfolio manager, but maybe they are not so good at managing organization. That cause them to fail. Cause them to fail. That's not the outcome we want to see.
Yeah. So sometimes traders can be incredible at being able to execute certain trades and invest, but maybe aren't good business people, or maybe they're not good in HR, or they're not good at putting infrastructure in place, or they're not good at marketing, or that's the funny thing is a lot of guys that come from one aspect, right?
Yeah.
That are used to a certain segment don't realize that for me, I break down organizations into 7 different areas, right? From communications to marketing, dissemination to treasury, to production, to quality control, to public relations. Those are the 7 areas that I focus on whenever I'm looking at any company. And I know that if I don't have all those areas covered, then I know I don't have a complete organization. I don't have my hands around the whole organization. If I don't know how to market it,
Yeah.
if I don't know how to produce the product that I'm expected to produce,
Yeah.
or if I don't, the executive division, which is the first division I think of,
Yeah.
it's just the brainstorm. Does the strategy work in the marketplace, right? Because
Right.
strategy is your start. Like we're literally, strategically, we've got has it worked before?
Yeah.
What's its track record?
Yeah.
And looking forward, does that strategy look like it's going to be a long-term strategy or short-term?
Yeah.
Right? So to me, from the executive division, that's like the first.
Yeah, I think, from my perspective, when I look at the investment opportunities, I focus on the opportunity sets. If we look at managers, that's their philosophy. And then we look at people, that's a team. Then we have look at the process, how the team utilize or integrate all the resources around them to capture that opportunity in the market, right? So people, philosophy, people, process, and then we look at
Profit.
Profits. How,
People, process,
at the end of the
profits.
day, how have they done, and
Yeah.
do we believe they will continue to deliver that kind of above the market return, right? In terms of philosophy or opportunity in the market, we look at it, look out in a few years, or 1 year, 3 year, 5 year. What are the inefficiencies in the market? Meaning, dislocation in the market due to whatever financial crisis or the sell-offs. Those all create opportunities for investment managers to add a return, right? So we try to understand managers, how they, what's their philosophy? Where do they believe the inefficiency in the market exists, right? Then the next step is that we look at the team, the research, the portfolio managers, the pedigree, the history, track record. Do they have the necessary skill set, knowledge, resources to capture that market inefficiency, right? Then, we need to, we have the people, the process, right?
Yeah.
Is it a repeatable? If you are don't have a repeatable process, despite you may have, you understand the inefficiency in the market, you don't have a good process to capture that. That may have a lot of risks. Then, the profits, when you have the inefficiency or opportunity in the market, you have the good people, they are very sharp, can do, backed by research, portfolio construction, risk management. You have a repeatable process. The return or profit will expect to come, right? That's why when I look at investment opportunities, I look at these key elements.
Yeah, it's funny. Let me give a real life example, my own experience, right? As far as inefficiencies, you take a shipping company, and the shipping company, the barrier to entry for a local trucking company is you go out, you buy a truck, rent a truck, and you get a license.
Yeah.
Right. So, but what happens is you start to do a lot of deliveries, and then you end up growing to the point where you need more than one truck.
Right.
And then you end up with 3 or 4 trucks, right? Then you need a warehouse facility for the facility. So you've grown from just a mom and pop to a bigger mom and pop, and you end up in this very fragmented industry. I know this from experience.
Yeah.
My friend Tom Bartley rolled up lots of these shipping companies into and sold to a private company, a PE company XBO for $62 million. I love him. I hope that you meet him someday. He's incredible. He's rolled up another $28 million in shipping companies because he just can't help it. He's already retired and done. He's like, I think 60 or something, but he can't help it, right?
Yeah.
But the shipping company that goes from mom and pop to small mom and pop, but the inefficiencies at that level, because they end up in a no man's land. They're not big enough, but they're not small anymore. When they were just a truck and a driver, and the wife was doing the bookkeeping, it was great. It was profitable.
Yeah.
Now they're in this sector where they're not big enough to get the efficiencies and the cost savings of being bigger.
Yeah.
And they're not small to capture the mom and pop. And they're in this no man's land.
Yeah. That's important, right? Inefficiency or opportunities in the market. If it's a crowded space, so many people are involved, investing in these, chasing these opportunities, then, why can we expect excess return from these opportunities, right? Because price is already bid up. That's important when you look at things. I think alpha opportunity or return opportunities only exist in these dislocated markets or inefficient market, right?
Yeah, I mean,
otherwise, why do you want to pay high fees for an investment person or investment manager to pick opportunities in those very efficient markets? You just buy index fund, right? At a lower fee.
Yeah, it's already working. But you figure these small shipping companies, they're worth 3-time multipliers.
Exactly.
But you package them together, they're worth 10.
Yeah.
Right? So because they're efficient at that level.
Yeah.
Right?
Not a lot of people are doing these things. That's why roll up, you create a lot of value, right?
Yeah. I mean, you triple the value. And it's weird when you look at it, but it's definitely, you're creating efficiency in the market. Yeah. And you get paid for that.
Exactly. Along the process, you make the market, your segments from inefficient to efficient, valuations goes up, and then you realize excess return or alpha for your clients, right?
Is it just me, or is this stuff just is so much fun to me?
Yeah, I think it's fun for people like you and me. Like, we enjoy it. It's like...
do you ever feel lonely that nobody understands what we're talking about?
I would be.
Right?
Yes.
I think a lot of times I feel starved for stimulating conversations.
Absolutely.
When it comes to understanding this realm,
Yeah, I think, different people have different interests in their life.
Yeah.
My interest is like having good friends, whether Andrew or other, very interesting, stimulating, learn from them, and they can also learn from me. And then, I really love investing, helping our clients
I love it.
achieve their long-term financial objective. That's what I'm passionate about. But other people, they may be interested in golfing or whatever other activity. That's totally fine. Just we happen to be passionate about investing and help our clients or friends achieving their financial objective. I think that's very exciting.
I think so too. It's so funny because it's funny. I mean, if you could think about the client investors, if they knew how actively passionate, we are about, this is not just, we're not just going to do something. We live this stuff.
We just enjoy it.
I learn
exactly.
Every time I talk to you, I grow. And, every time, like when you fly back to Boston, I dig deeper into the stuff we talked about. And I'm like, I didn't even know it. Right? So we bump into areas, I think, that you get to see that I don't get to see. Like if I could look at every one of your deals, and I would learn so much from looking at your deals and the strategies and, what you're doing, that, I wish I had the time to just sit and go through every deal because I grow.
Yeah. Meanwhile, I learn a lot from knowing, how an entrepreneur, right? Identify the opportunity, have a vision, and build the business from ground up, right? That's very fascinating.
Yeah. Well, we hope with Club 67 that we'll be able to, because that's my growth, right? Like you're at the top of the food chain, right? You're like the shit.
But I'm also the clients.
I know you do, but and I'm going from that entrepreneur visionary putting stuff together to private equity, buying the companies and helping other people come up, that are in that C-level area.
Yeah.
So that we can package them, create efficiency, and then move them in the higher markets.
Yeah.
Because that's the gap. And what's funny is, when I realized that 3 years ago, that $1 trillion a year has to trade hand with the baby boomers.
Yeah.
And that 86% of those companies were closing. Talk about inefficiency.
Yeah.
Is there any other inefficiency that huge?
It's huge, right?
86% of those companies are closing.
Yeah. But there are some valuable assets within each of the failing companies, right? If you can, figure out a way to retain these valuable assets, integrate them, consolidate them, roll up, and you can create a lot of value.
Yeah, and what's weird is it represents 80% of the jobs.
Yeah.
So I almost, I'm not a socialist. I'm not a communist. I am a capitalist.
Yeah.
I'll be honest.
Yeah.
And I believe in the American capitalistic system, and I'm a huge fan of it. I think it cleans up markets if you don't meddle with it.
Yeah.
But to be able to see the opportunity to save jobs, to retain income, I don't know. It excites me.
Yeah.
And what's funny is my most talented people are interested in it and want to do something about it, which I think is awesome. And yet, no, there isn't one single person that's part of Club 67 that needs money.
Is that right?
There's not one single person that's part of its creation and its conversation that actually needs a dime, which I think is cool. It's it's just those are the numbers we did on the board. I think we took them down. We took them down. Okay.
For Club 67?
Yeah.
I don't know. They're still scattered all around the board with a bunch of.
But we took the video down, right?
Oh, the video's still up.
Oh, okay. Well,
So
yeah, because Anya wanted to take that down because she thought it was just too detailed. Anyway, I digress. So, but yeah, we broke down all the numbers. Yeah. Somebody. So, a guy that comes into the business, right? The operator, right? The one that's going to be saddled, comes in with walks out the door with $3,731,000, basically $4 million after 3 years.
Yeah.
After he put in 47,000. So he puts in 50 grand, he walks out the door with 3.7
Yeah.
in 3 years.
In 3 years.
So the idea was that he's got to put skin in the game.
Yeah.
Whatever's,
Yeah, when we look at investment opportunities, we look at when we evaluate a team, right?
Yeah.
Imagine to put that skin in the game. That's a really critical, right? Alignment of interest.
Yeah.
How they structure the economics of these investment returns or these deals aligned with the client's return, right? You have the compensation of the portfolio managers, analysts, deal makers. How is it aligned to the investment performance of the clients? That's critical, right? It's we are all human beings. We want to all make a good living for our family, and we want to make good income. But we also want to see in that process, we need to align our financial well-being with the clients' financial well-being, right? Of course. That's how it motivates people. It's capitalism. We share our prosperity, right? We do a great job for our clients, and we will do it well for our own family.
Yeah, I was thinking if people they don't invest.
That's you need to invest.
You don't believe in your idea.
Exactly.
It's like, for example, whatever they invest is going to be their equity piece anyway.
Right.
So if you're going to get that back out, do you not believe? Because if you're not going to get that money back out, what are the chances that you're going to get the money back out?
That's
right?
a great point. Yeah.
So it's like it's not like you're not like donating the money. You're getting equity for the money you put in.
Yeah.
So if the equity multiplier is going to go from $1 to 400,
Yeah.
and you really believe in your idea, why wouldn't you put everything you have in it?
That's the point. Yes.
Right?
Yeah.
So I've always thought that. I've always invested my own money since 12 years old,
Yeah.
right? Like literally it's always been my money. I have banks that give me money. Banks give me money all the time.
If
I got like 40 banks. They'll give me money all day long.
if you don't believe in yourself, why do I need to put money with you, right? That's
Right, yeah. And it's funny because I've, in dealing with banks, I've always put money in, right? And you're not a banker. You're much, much higher than a banker. I don't want to put you in a banker category.
Okay.
But I've always looked at bankers and said, if you don't believe in this, because I consider you a partner, I don't want you to invest in it. If you find anything wrong with my plan or my strategy, and you don't believe in it, then because that was really for me, honestly.
Yeah.
Even though I put my own money in it, it was really my test to know that they believe in it too.
Yeah.
Right? Because when you're an entrepreneur and a visionary like me, you can get delusional,
Yeah.
right? So you need people to like set some reality in place and go, based on the markets, based on this, based on that, because we can get like colored lenses, right, of hope, right? So I think it's good when you have pragmatic observation,
Yeah.
right? And I invite it because it just makes whatever I'm doing better.
Yeah. I think we just play different role in this society, right? Bankers have that important role. I'm different from them. And we all each play different roles. Bankers want to make different deals, transactions, facilitate different parties' transactions, right? We as a portfolio managers or fiduciaries, we manage clients' money. And you as an entrepreneur, you want to build a business, right?
To
We all
create
play
something.
create something. And we all play important different roles in this society, right?
So if you were to look at a banker,
Yes.
I know the answer to this, but I want to hear how and we know the answer, but maybe they don't. So speaking from the viewpoint of a banker compared to you as an investor,
Yeah.
right? The difference in objectives.
Yeah.
So a banker has what objective?
I think bankers, from economic perspective, their revenues come from transactions, right? How many transactions? What's the deal? The volume, dollar amount? They
Points of
complete.
interest, right?
Yeah, point of interest. And for us, difference. We manage clients' money. Our performance is measured along based on the long-term the client's objective. Say if it's a pension plan, they have that unique. Each client pension fund have that liability profile. They have the existing employees. The demographics is unique to that company. They have retirees. Then you have that's a liability side, right? You have made a promise to your defined benefits pension retirees or employees in the future. You are going to honor that in the future. Then you have assets, pool for assets. Now sometimes your assets may be lower than the liabilities, means it's underfunded, right? Or your assets is higher than the liabilities, it's overfunded. Now when we manage the assets, we need to factor that into how we pick investments, right? How we construct portfolio, because of risks associated with the underfunded versus overfunded pension plan are different. Also, we need to think about the companies, right? Their financial status. Are they in a good shape? Are they, in the position of contributing continuously each year to the underfunded pension plan? All these factors will impact how we construct a portfolio when we look at risks, right? Say, if a company is severely underfunded, now they cannot afford to put more money in. Do we want to? You have different choices. One, you can theoretically, you want to make this aggressive, more risk-taking approach associated a potential high future return because your assets return need to catch up with the liability.
Right.
But that's really risky because
Are you able to change the deal structure during that process?
yeah, we work with the clients, try
Okay,
to
so you
understand.
can-
yeah,
you can-
we need to understand the
Because
clients.
if you're taking on more risk,
Then more risk associated with potential high return, but
Right.
potential more downside. right?
exactly.
Or if you are fully funded plan or even overfunded pension plan, now you can afford to be more conservative. You put a bit more, say, fixed income assets, which can hedge your liabilities better. We call it liability driven investing. And even long-term expected investment return is lower than if you invest more aggressively, but it mitigates the volatility of your shortfall, right?
Right.
It'll reduce your shortfall risk. That's important to institutional clients. I think even for an individual, you need to think about this as well. If you are in a good financial position, do you want to protect that your wealth, you protect your wealth, you protect the financial well-being of your family, right? That's the same thing when you look at institutions and individuals or families. You have your liability as a family. You need the future spending needs, your lifestyle, well, how much you need to spend, what you borrowed, how much assets you have. Now you need to invest the assets, right? And you need to consider what you try to achieve for your family and for yourself. Make sense?
Yeah, I think it's all, how you do one thing is kind of how you do all things,
Yeah.
It's one of the things I know even with trying to pick people that to invest in businesses, like how's your credit? Do you pay bills?
Exactly. You need to assess all the risks, not just look at potential return.
Like-
you need to look at risks.
Like,
right?
for example, if you're carrying a $20,000, interest on a credit card at 29% interest, and you could have simply paid that off,
Yeah.
what did you spend it on? It gives me a good outlook on like how you're...
Exactly. If you have a 29% interest, if you still want to borrow at that interest level, it tells something, right?
Yeah.
Either you are not a good financial manager, right?
Yeah.
Or something else is going on.
Get a signature loan for 6%, 5%.
Yeah.
And then, what's worse is I'll tell them, you can go get a signature loan for 50,000 based on your credit score.
Yeah.
They still don't go do it.
Absolutely.
They still pay the 29% interest every month.
Yeah, we see this all the time. Most people as an individual, we call them these behavioral biases, right?
Yeah.
They put their different money in different segmented in that brain.
Yeah.
Your money in your house, your money in your bank account, your money in your brokerage account. They treat them separately, but that's not the rational way to do it. You need to think about your financial assets combined, your real estate, your bank savings, your brokerage account, your other investments. Group them together, and then you have your liabilities. What's the debt? What's your spending, right? And then you need to look at the whole picture and when you make investment decisions. But that's not what most people do.
No,
they
not at
segment
all.
their financial assets in that brain in different compartments. That's
It's a funny story.
So that's why they are willing to pay 29% interest on their loan, not willing to pay off. They make investment in another pocket, making 6%. But you may just liquidate that investment yielding at a 6% pay off that loan. You will be much better off. But many people don't think that way.
Yeah, like about 23% difference.
Exactly.
Yeah, and it's eroding their actual savings.
Exactly.
And it's because I see it. It blows me away. We had a practical example of that. So one of our companies, we had a controller, and I was like, they would spend all the money that came in the account, right?
Yeah.
So that, and I'm like, our goal as a company is to make a profit, right? Mm-hmm. It's the net, what I call net. like there's a net at the bottom of the company and the money falls out and it gets captured in the net, right?
Yeah.
Like the goal is the most money in that net wins. Like that's the goal, right?
Yeah.
Is to net profit, to capture it in the net, right?
Yeah.
If we don't have free and clear money, we actually are wasting our time as a business.
Yeah.
So, and then I started asking the controller that was controlling that particular business. I said, so tell me about your financial, and I said, I'm like, have you ever gotten a check for like 10 grand or 15 grand or something just out of the blue? And they're like, yeah, I got a $50,000 settlement check. I'm like, oh, so what did you do? Oh, I bought a tattoo for my boyfriend. I went out and I bought a new car. The $50,000 was gone in less than a month.
Yeah.
So I have a controller that's helping make decisions in a company,
Right.
right? That at the end of the day, she spends everything in her bank account. Everything.
Not making rational financial decisions in her private life, right?
Yeah.
Yeah.
And I thought about it. I said, her mentality is to spend everything in the bank account. Why would I ever expect that there would be extra money
Yeah, exactly.
when her mindset is a broke mindset, right? She doesn't have a savings profit driven mindset about here's what we're going to end up with. I saved us this money over here. I saved this money over
Yeah.
there. I did all this stuff.
Yeah, why would you trust this individual to make the best sound financial decision for the company, right? Because of the person's behavior in other sides of private life, right?
And it's weird.
Yeah,
but
that's a- but-
so many people have that broke mentality.
Exactly.
You can't give them money that they'll just spend it.
Yeah.
If analyzing, because I underwrite so many deals, right, in the banking arena, and I'm like, there'll be guys that make $1 million a year. They're broke every month. Every month they're broke.
Yeah.
They spend every dime. Rather than saying, okay, I'll have this lifestyle, I'll have this, and then I'll save here,
Yeah.
right? And then I'm going to protect what I make for the future. I'm going to invest it.
Yeah.
They spend every dime, and most Americans are that way.
Yeah.
I look at
unfortunate.
thousands of loans, and that's what I see. I mean, unlike our goals and objective is to, see a net or a profit,
Yeah.
it's amazing. It blows me away.
Yeah, that's a human being, right? Not all humans are rational. They
Yeah.
make decisions based on whatever that past experience, that feel of life, right? That feel of future.
Yeah.
And many of their decisions may not be financially prudent,
Yeah.
right, for
Yeah.
themselves.
True.
That's a way of life. Even in the financial markets, when you look at over long term, say stock markets, right? It goes up. Over long term, you can expect 7-8% annualized compounded return. But when you look at institutions, they are doing well. They can be that in return over time. When you look at individuals, some of the individuals active in the stock market trading, making that either mutual fund investments, ETF investment, or stock investment decisions, right? When you look at that track record, most retail investors lose money. They may be just better off investing in the index fund, just leave it alone, right?
Yeah.
And when you even look at investors, just invest in mutual funds, you would think, they will get a mutual fund performance.
Yeah.
But because of behavioral flaw or behavioral aspects of individuals, if a mutual fund does say 9% annualized return, you look at all the retail investors in that mutual fund, over time, they only get like 5.5% return. The gap between mutual fund return and the actual realized return of the retail individual investors is big. Why? Because many investors look at past performance, they sell high and they sell low and buy high, right?
Right, yeah.
And buy high and sell low. And they underperform even the mutual fund they bought because the timing decision is terrible because of that, behavioral weakness. But that's a human being. And good portfolio managers or institutions try to help is to mitigate some of these behavioral biases, right? If you can help you, whether financial advisors or institutional investors can help your clients to mitigate or eliminate these behavioral biases. You can add a lot of value, right? When you look at the mutual fund return, if a single mutual fund 8% return, all the investors look at historically only did a 5.5% invest in that mutual fund. It means something is wrong because these investors buy high and sell low. They always made a wrong decision. But that create opportunities for professional financial advisors or institutional portfolio managers like us to add value to clients.
Yeah, and to take that emotion out of it too.
Exactly.
So if in wrapping up, I think what would be the best advice, not legally.
Yeah.
Right? No one's paying you here.
Yeah.
So go see a financial advisor or invest. If you can find this firm, we're going to keep it a secret. What would be your best advice for people about money? This is Money Monday. So
Yeah, I think
about money.
Yeah, about money. I think you need to have a good understanding of what's your current status financially, and over the next few years, what you can achieve. Right, current status. What's your savings? What's your investments? And what's your liabilities? How much you borrowed? What's your mortgage, car loans, and all others? Right? You have your assets. You have your liabilities. How good you are in that on that measurement. Then you need to consider what's your income, right? And today and in a few years. And then you need to have a plan to to save first and foremost a portion of your income to make investments. And if you don't have a lot of time following like stocks or bonds or mutual funds, you may just look at some financial advisors, not high cost. Seek them for just strategically the advice. What kind of allocation you want to make? How much in percentage of your investment portfolio, say in equities, U.S., non-U.S., emerging markets? How much of your allocation in the bonds? And if you're a high net worth individual, right, you may want to consider the allocation to venture capital, private equity, hedge fund, these private vehicles. Once you have that strategic allocation set, and if you don't have a lot of time looking at foreign investments on a daily basis, you implement these investments with the passive. You go to Vanguard, buy this index fund. If the advisor said you invest 40% of your portfolio in U.S. equities, just buy S&P index fund from Vanguard at a few basis points cost. And then you come back to reevaluate your overall portfolio performance with your financial advisor, say a year from now, then on an annual basis. You don't look at it on a daily basis because the volatility in the market will cause you to think differently, behave differently. Yeah. But you don't really have the either knowledge or the time to follow on a daily basis, right? Yeah. Just think strategically, where are you today, assets-wise, liability-wise, and then what's your income potential today and the next few years, and have a plan for that, right? Yeah. How to invest and a bit more passive, not to day trading stocks or mutual funds. Yeah, exactly.
That's gambling. Yeah.
And then you also, of course, you want to review overall your portfolio performance and your financial status, right? Once in a while, but you don't want to do it every month, because you either don't have the time or don't have the knowledge to do it daily, right? You may want to spend your valuable time on what you are good at on other aspects of your life, whether building a business or do whatever you like. If investments is not your specialty, right? That's my advice.
I agree. I think that's good practical advice. I personally probably look at mine about 5-7 times a day. Over 70 different accounts. I'm like, but I enjoy it. It's but I don't make decisions daily on stuff.
Right.
I'm definitely a long
Because
person.
if you are doing too many times a daily basis, you are always swayed by the market. What's going on at the particular time?
You're creating. You're if
You lose long-term vision for what will evolve over time, right? You just focus on too short time span on a daily basis, and
Well, I'll give you a perfect example, right?
Yeah.
So, Buffett's Berkshire Hathaway went from 15 multiplier to 11 multiplier. He just dropped on Wednesday $1.7 billion that he bought up in stock, right? Buying his own stock back because he can't buy companies.
Yeah.
And quite conveniently, $340 million worth of a mistake that he made in a Ponzi scheme with solar came out.
Yeah.
Right? So, and he's actively buying his own shares back of his own company.
Yeah.
Right? If I was to make a decision on Berkshire Hathaway today, based on what I'm seeing, I would sell. But based on what I know, I would buy.
Long-term basis, right? If
got-
you look at today,
Yeah.
for that particular case, or what's going on, that solo bad investment, you are inclined to sell. But when you look at overall picture over longer time, you want to buy.
We've got solid companies. Of course, Heinz and Kraft are having problems right now. Nestle made a great decision about the direction they went in. They called themselves a health food company.
Yeah.
And their multipliers are incredible. We saw Michael Milton drop that load right out
Yes.
there. Of course, Berkshire Hathaway owns Kraft and Heinz, right? Or Kraft, right?
Yeah.
So we have those. So they went the wrong direction. But he owns 66 companies that are all solidly entrenched. He did incredible with the railroads.
Yeah.
So his multiplier is low. So he's on sale right now. He's got an incredible brand, right? So if I'm looking at it from an overall objective, if I own Berkshire Hathaway, I would be buying more today, not selling. So
Although you want to consider other factors like age of these two principles, right? That succession plan, these are long-term. These are risks. You need to factor in, right?
There's no Buffett Jr. that I'm aware of.
Exactly.
There's nothing like
Yeah.
that. So,
But you consider all the factors, you make informed decision. That's all you can do, right?
absolutely.
Yeah.
So if I sum it up, I mean, Jay is saying that, get really aware of where you at, both with your assets and liabilities, what the value of what you have is, and then what you owe. Take a look at what you're making today, what you think you're going to make in the future, and put away, not just save, but invest that money. And if you're going to do nothing else, of course, get with an investment advisor, because that's not what this is about. Buy an index fund that's going to, and figure out from your investment advisor what an index fund is, because if you're going to, doing nothing is not a good idea, but definitely save and invest in your future so that your future is brighter than your present. And, the first thing is really getting soberly aware. Like I've brought many people through understanding what their balance sheet and their income statement in their personal life looks like. It's a rude awakening. And once you do it and you actually accept it, it feels so good. So I again, thank you so much. I'm so honored that you would take the time to be with us today. G is amazing. You won't see him anywhere because he does not go on social media. He doesn't go on PR. You won't find him on Bloomberg. You won't find him anywhere. He is a personal friend, and he is freaking brilliant. So I'm honored to have him on, and I hope you enjoyed some of the gems that he's dropped. He's a brilliant guy and definitely knows his stuff. So anyway, thank you so much for watching Money Mondays. Thank
Thank
you
you.
for coming on the show. You know, take care. Take care, guys.
Goodbye.